Hey, welcome to Going Greek. This is Introduction to Derivatives Trading for Beginners. My name is Matt Rivas.
And I'm Seth Schmidt. We're going to quickly just give you a brief history about where we come from, why we're doing this. We're students at Miami University. We had a finance class where we discovered options, and ever since then, we basically fell in love with them. We wanted to learn anything and everything that we could about these things, and it kind of just started to consume our lives a little bit. And
oh yeah, I should be studying for finals right now.
Yeah, and we just decided that we really wanted to really understand these.
These options and how to trade them.
Exactly.
Yeah. Quick, before we get into this, I apologize for the recording room we're in.
We just
Apparently,
don't have the best situation right now.
Yeah.
We would love to be able to point things out, get up in
And
front of the
get
camera
up-
for you guys.
exactly.
We just can't right now due to policy issues. We're not going to get too deep.
Oh, wait.
All right.
Alright, so
And
wanna start
basically
out?
the purpose of this podcast, getting back on track here, is we're going to be kind of starting from point one of a derivatives trader, and that's sort of the point that we're at. We noticed as we were going along, we were making a lot of mistakes, and we decided it'd be a good idea to maybe document these mistakes, go through them, and expose other people that want to get into this field, and maybe help some people not make mistakes, the same mistakes that we did.
We're one big segment that we're going to be featuring on this podcast, and I'm 95% sure it's always going to be, at least part of every episode, is going to be a pitfall segment where we discuss common trading mistakes for beginners.
There's always going to be mistakes.
Yeah,
I doubt
yeah,
we're going to
yeah.
be perfect anytime soon.
One
hopes.
I don't know
One
about you,
hopes.
but I'm pretty perfect.
Oh, okay.
Yeah. It says
We're just
Matt.
gonna move past. We're gonna plow past that statement, and we're gonna get into the basic bare bones of what options are. They consist of puts and calls, and how to think of these as you're basically buying or selling a right. So if you buy,
You're buying and selling the right to buy stuff.
yeah, it's
Yeah,
a
buying
right
underlying.
to take action, really.
Right.
And so if you have a call, that is the right to buy.
Not
but
the obligation,
You
though.
do not have to.
There is a difference, though. With futures trading, you do have the obligation. Unless you sell the future before the expiration date, whatever you want to call it, if you hold it to expiration, then you're obligated to buy the future.
Right,
Yeah.
yeah. We're gonna stick a little bit closer to the options for this podcast.
I just wanted to make.
Oh yeah, no,
that
that's
key
definitely a good
difference,
point.
yeah.
Definitely a good point. So like I said, calls, right to buy, puts, right to sell,
Right.
and these consist of two types of value: intrinsic and extrinsic value. And the more straightforward one and easily distinguishable is the extrinsic value.
Extrinsic value,
Yeah.
out of the money options. The
With extrinsic
extrinsic
value.
value is the price. It's how much they cost. If they're out of the
Yep.
money. And when we talk about in the money, it means that the trade has gone our way. It's gone past our strike prices, however we want it to. So we're going to be making
means-
a on that. It has more value than just the
So
extrinsic.
from
It
the
has
point
an
of view of a
intrinsic
call,
value, too.
and in the money call, what you're looking at is you have the right to buy the underlying asset at a price lower than it's currently trading for in
Exactly.
the market. So what that does is you can go in and exercise your call,
And collect that intrinsic value.
collect that intrinsic
Exactly.
value. Yep. And in the money put would be when you have the right to sell something at a higher price than it's currently selling in the
Right.
market.
Yes, exactly.
So for puts, you really want the price of the underlying to go down, and calls,
I mean, if you're long puts.
yeah, we're going to build up. We're going to
Okay.
build up. We're talking about long situation here.
Okay.
But right, yeah, it can go both ways. But
Yes.
from a bare bones point of it, that's
Fair
what in the money, out of the money is. At the money are calls that are right at that point of being in the money, out of the money. Think of like the midpoint. They could teeter either way, and they have their own category. They're usually pretty volatile.
Yep.
And yeah, so it's really good to know what side of the coin you're on.
Right, exactly. And we're gonna expand on this being on the right side of the coin thing as we continue
Yeah,
the
yeah.
podcast. One
Just to
thing
go over it again.
I don't think we distinguished at the money between like in the money and out of the money. It just means it's an out of the money option that's right on the verge of becoming in the money. That's all it is.
Yeah.
Yep.
And another really key point about options is that there is an expiration point for these. So you cannot buy this right and then hold on to it until the conditions are perfect for you to exercise it.
Right.
There is a sense of urgency, there's a time factor, and that's
Yes.
where a lot of the extrinsic value comes from.
Yes, exactly.
Mhm.
Yep.
Right.
Okay.
Let's go into quickly go back.
Oh,
Let's,
we're
let's
going
quickly go over what long and short means for some of
Oh,
your
okay.
experienced traders out there.
You might
You're
wanna
probably
skip ahead.
familiar with these terms, but long is basically interchangeable with buy, and short is basically interchangeable with
With
selling.
sell. Yeah.
And you can reach some confusing points when you start thinking about these options, especially for some of the more like complex spreads that you
Right.
might do. Is looking at like long calls, long puts. Like, what does it actually mean? And a good rule of thumb is if you are getting confused, just interchange the words with maybe buying the right to buy.
Instead of long call, instead of buying a call, you're buying the right to buy the stock. Instead
Exactly.
of buying a put, you're buying the right to sell a stock. Instead
And this can help you when you're
Yeah.
formulating your own strategies going forward. And eventually, you're definitely going to get it. It'll click.
absolutely.
And once it does, you'll just know exactly what you're talking about. But I've just noticed for a lot of the newer traders I've been talking to that can be pretty confusing.
Oh yeah,
And-
you won't, I see this. I see this in like online forums about options trading where people are like, people are confusing like these long calls, long puts, like short puts. Like it's kind of
Yeah.
it's something that you need to get a grasp on before you start trading these instruments. It
And
really
just
is.
changing up the language a little bit is a great way to really get a good hold on that.
Absolutely.
And like, we even had to do a little bit of double checking on our presentation
Yeah.
here.
I panicked 5 minutes before we started recording. I was like, oh, did I write this correctly? But
Yeah.
let's go forward to the short side.
Yeah, this short side is going to be kind
Where
of the
we're at.
world that we live
This
in.
is
We
where
like
we
to
live.
be in short positions, so we like to sell the right to buy and sell the right to sell.
Right, and
Essentially.
like this is what I mean by selling premium. Like we're generally selling stuff out of the money, and
Premium is the equivalent to the extrinsic
It's- yeah,
value, to
it's
the
the-
price. Like
like,
we want to
yeah.
be collecting that money up
We wanna
front.
be
So,
collecting
quick
premium.
example, just
Look, I mean, we have examples where we're.
oh no, I'm just saying like
Okay.
just a real quick example. Like if
Alright.
you're selling, if the price of an option is $4 and you sell that option, you're going to collect that $4 initially.
Oh yeah,
And that's the position that we want to be in as individual traders.
I
here.
mean, it puts us on the right side of the coin, really.
Yeah, I
as
mean,
far-
obviously
as far
having
as-
money up front, like
Yeah, I mean, like there's that. Like you're collecting that credit, you're controlling the cash, and you're also like just by doing that, you're putting yourself on the right side of the coin, which we're going to demonstrate to you. as we
you're
go
skewing
through
the
this.
odds in your
Yeah,
favor, which is what
absolutely.
we want. Like that's how I believe options, like the true strength of it comes from, is that you can really define your odds.
Yeah,
of
you can
going.
essentially become the casino, become the house.
Essentially, yeah.
Yes,
Yeah.
absolutely. And so implied volatility, this is huge. It's very important to understand.
It's like
but-
the driving force of all
of,
options.
and
really.
of how we trade, pretty
Yeah,
much as
yeah.
well. Implied volatility of it's just the implied volatility of the underlying. How much is this underlying expected to move up or down? You know, that's all it is. And so this.
For example, we see an IV of 30%.
And it's
That
just-
means the underlying is
and-
probably going to go up or down
by
30%.
30%. That's
Within the allotted time period based
Right,
on that
yes,
option, which is
yeah.
a huge point.
right.
Because different options with different expirations are going to have different implied volatility.
Absolutely, 100% correct. The most I think important part about implied volatility is IV rank.
For our trading strategy.
For our trading
Yeah.
strategy, absolutely. And so.
I'll go back quick because we missed that the fact that implied volatility almost overstates
right.
the realized volatility.
That's what I said then. That's on.
Yeah,
me.
yeah, no. And what we mean by that is that we have this implied volatility number that traders think are going, what the expected move is going to be. But in reality, statistically speaking, it's usually overstated.
Exactly.
Implied
In a
volatility.
statistically, I want to stress in a statistically significant way. I
Yeah,
especially
yeah.
want to stress that it's statistically significant when we say that it's overstated,
Definitely.
that it is overstated.
And that's stuff, and that's going to play into our personal strategy here,
Exactly.
and the one we're going to be focusing on going forward.
Yes. Yeah. All right.
Realistically.
So let's go over IV rank. It's pretty simple. It's just a measure of implied volatility measured against itself over a period of time.
It's on a percentage scale from
Percentage
0
scale.
to 100.
0 to 100. We want to see that. We want to see those high IVRs
Yeah,
for
for our strategy.
We want, because we're volatile. I did this earlier. We're arbitraging volatility.
We're volatilizing volatility.
But yeah, no, we want this high IV rank because implied volatility historically overstates realized volatility, And implied volatility is a driver of an options price. The higher the implied volatility, as we see here, the more premium we collect.
Yeah, and that ties back into
Yep.
what we're talking about, the extrinsic value. We want that to be high since we're selling it.
Exactly.
And the fact that the price goes down as you're leading up to the expiration point, where at some point we want to buy back this option that we
yes,
sold.
we're going to need to close out our business. There's two trades.
So we want it to be at a lower price when we buy it back,
Right,
and then we
absolutely.
capitalize on the difference between the price that we
Yeah.
sold it and the price that we bought it.
Yep.
And just to give a quick example of IVR, as far as the 0 to 100 scale goes, say an option has an IVR of 100. That means relative to itself over the year, it's trading
To that underlying.
to that underlying. Yes, sorry. Relative to that underlying, it's extremely volatile.
It's as volatile as it's been in the last year.
It's
Yep.
peak. That's a really volatile
Really,
underlying.
It's
And if
important
it's
to
0,
understand
that means that it's not volatile at the moment. And this is also can be a little bit, I don't want to say confusing, but for lack of a better word, confusing, because some options can be inherently volatile, and some options are
Underlyings.
Need to get that.
Yeah.
Underlyings can be inherently volatile.
But they're at trading at a low IV rank, like say JNUG. I think
So-
I don't think I've ever seen JNUG trade with less than 100% implied volatility.
So, and that's
Less
just
than 100
that just goes to
IV.
show
But
that
its IV rank is at like
Yeah.
36 right now or something like I don't know. So this is
Whatever,
been creation
whatever,
units,
whatever.
whatever.
what the point is that it doesn't necessarily measure that this is a volatile underlying.
Oh yeah.
It's just saying that right now
Now,
it is
compared to
volatile.
itself, it's volatile compared to itself, which
Yes.
is what we care about.
Exactly.
Which is what we care about.
Exactly.
And so higher implied volatility, all right, I skipped the point. Implied volatility and hence IVR will increase when the market declines and also leading up to binary events such as earnings, elections, etc. You know, all of that good stuff. And this higher implied volatility is going to lead to higher option prices. So that means that when we're selling at this high IV, we're collecting more premium to make money on. And Tasty Trade, gotta love them. We use them a lot for our own research. They have a really good analogy about IVR, and it's low IVR is a skinny pig. You're a pig farmer, and low IVR is a skinny pig. High IVR is a fat pig. You don't want to take your skinny pigs to the market to sell. You want to take your fat pigs to the market to sell.
It's
So
that juicy bacon.
get that juicy
Juicy
bacon.
bacon.
You love me
Yep.
some juicy bacon. Oh yeah. Okay,
So yeah, I think we pretty much covered everything we
Yeah,
need for that.
for at least
for now.
for
Yeah.
a beginner, yeah. Greeks, we're gonna get real in depth into these. I could talk all day about this.
I think we're planning on having a podcast for each one individually.
I
That's
could
gonna be our
definitely
goal
do that,
here.
yeah.
So
I know.
this is
I
gonna
need to
be
talk
a
about it to somebody besides my friends who don't want to hear about it.
pretty much everybody you meet.
No,
Oh yeah, man. Have you heard about Gamma?
Oh, dude, what do you know about first order derivatives?
Oh,
Man.
but this is gonna be just an exposure to these.
First order
so
Greeks, not
don't,
first order
don't be
derivatives,
afraid
my
if
bad.
you don't be afraid if you don't get it on
Yeah.
this first run through.
But let's hop into delta,
Mhm.
which is just simply just the rate of change in the option price given a $1 move in the underlying. And so, if you're long on an underlying, you're going to have positive delta. If you're short on an underlying, you're going to have negative delta. And you can create these long and short positions by various combinations of buying and selling puts and calls.
Right. It's how the option price reacts when the stock price moves.
Right, exactly.
Is the simplest way to put
And
it. I
gamma,
think.
right? Yeah, gamma. Gamma's a tricky one. Like even for us, like.
We have a lot of research left to do on gamma.
Gamma, for now, we're just gonna say that the way we trade is to avoid gamma risk, and gamma is the rate of change of delta, given moves in the underlying. Like that's all we're gonna
just
say
gonna
about
leave
it.
it at that.
Yeah.
Yep.
Theta.
Theta's this is the one that Matt will ramble.
Oh
and
yeah,
ramble and
I
ramble.
love listening to theta, but theta is the daily decay of an option's extrinsic value, assuming constant implied volatility in price. Now that's not you're not going to have
A little bit of a
constant.
mouthful with that.
Right.
Um,
I'm gonna get into it. You're not gonna have constant IV. You're not gonna have constant price. All right. But basically, what this is saying is that if you're short options, you're selling premium. You're long theta. You have you're positive theta, which means that the natural time decay of the extrinsic value of the option, is working in your favor. That was a mouthful.
we want that price to go down. We want that theta to be positive.
That we want theta to be positive because
Yeah.
it's going to drive the price down.
Because, like we said before,
Like,
we're
not even
planning
that.
on
It
buying
just
this
happens
back.
naturally. It's just
Right,
a natural decay.
Right.
Is all it is. So you hear us talk about time decay, time value, theta decay, theta. That's all we're talking about. Vega is the rate of change in implied volatility for a 1% move in the underlying. Vega is another one of the important Greeks, especially to how we trade, because we're going to benefit from being short Vega as premium sellers. And basically, you just need to know if you're short Vega, you're going to benefit from contracting implied volatility. If you're long Vega, you're going to benefit from expanding implied volatility. And we'll get deeper into that in another podcast, I think.
Oh yeah, definitely.
Oh, yeah. So
Our
now-
personal strategy as premium sellers, like we stated before, high IVR, definitely what we want. Short
Right.
Vega and positive theta.
Yep.
And that's pretty much it. Like that's kind of what we're looking to get.
Oh yeah. I mean, obviously, you want to build your portfolio around your deltas for your directional risk. Like depending on your market assumption, is how you should like if. For example, like you might need to get short delta, so you don't necessarily place a trade because it's a good trade. You're like, oh, I'm short delta, maybe I want to get a little bit longer, stuff like
Yeah,
that.
standard diversification
Yeah.
definitely applies to
Yeah,
option
absolutely,
trading. There's
absolutely.
no
does.
way around
Your
it.
portfolio should include a various assortment of.
And all these
of
Greeks are just
strategies.
good benchmarks to
Yeah.
see how you relate to the different underlyings
Oh, yeah.
that you're exposed to.
Absolutely. And we're going to strategies for us. We're going to be focusing on strategies for smaller accounts. We're talking 5K or less. Like we're college kids. Like we don't even have 5K in our brokerage.
Not that you can't apply these things.
Right, exactly. But like if you have a $50,000 trading account, you're naturally gonna be able to place. You're gonna have more buying power. You can place.
Right.
You can place those naked straddles, so you can sell those naked puts, collect that more premium. But for us smaller accounts, we're
You
gonna
don't
define
really
our
have
risk.
access
We
to
don't.
some of the other stuff, so
we
you
can't,
guys see a
we
lot
can't do
more.
those strategies. So we're
Yeah.
gonna define our risk, reduce our buying power, and we're still gonna come out on top. We're just not going to be able to collect as much premium as we would with a naked strategy.
But we're still going to be focusing on the credit spreads.
Absolutely.
And what I mean by
not just
that, credit
spreads.
versus debit spreads.
Yeah, like we're gonna focus on collecting our
Yeah,
premium.
we want to be
Yeah.
when we enter the position, we want to be collecting money, not spending it.
Right. I mean, again, dependent on the volatility environment and everything. But if we're in
Of
a
course,
natural
of course.
environment, this is what we're following.
General rule of thumb.
And as a general rule, this is just how we trade. This is how I'm probably always going to trade. I'm probably never going to deviate from this. Selling at 45 days to expiration, and by that I mean entering the trade at 45 days to expiration. I want to be clear. And then I'm going to manage that. If it's undefined risk, and let's say it hasn't gone against me, I might roll it out. Whatever. We're not going to really get too deep into that. But
we want to be
managing-
looking to enter trades
Days.
where options are expiring in 45 days.
Days, in
And
45
that gives
days.
us the most amount of time. We'll definitely
we're
give it
collecting
a
theta.
little more specific reasons into that. We don't even know. We don't even know
Fair
yeah.
enough. Fair enough.
Just if you're looking to enter into your first trade, look at those expiration dates that are as close to 45 as you can get.
And then when you really want to start managing at 21 days to expiration, because after that is when you start to see, though it starts to get a little bit wild, and you start to see some of these Greeks overtake the Greeks that are benefiting you. That's all I'm going to put it as for now.
Right.
And
I think the last point here, though,
is the most important.
the most important part, and I think this is something that can be a little bit, I don't know, counterintuitive for some of the entry-level traders, is that we're not necessarily looking to shoot for the moon in each of our trades. In fact, we
Almost
don't.
never. In fact,
Almost never.
If
Yeah.
I get 50% max profit out of a trade, I'm running I'm taking it. I'm running like a thief in the night.
And so just a quick pen and paper example here, going back to that $4 put we were talking about. We sell that put for $4, and now
It's
an important thing to know about options is when you're buying and selling these contracts, they're in multiples of 100. So that $4 isn't the $4.
That's the price of a single put, but
Yeah.
you're buying a contract of 100 puts.
So it translates to $400.
Absolutely.
So we collect this $400, and we're looking to
collect 200
200 of it.
That the extrinsic value of that put moves to $2. We sell. We're out of there. We don't hold the expiration unless it's a max loser, and the only thing we can do is win from it. and we'll get further into that. But I think that's important. That
Well, yeah,
people
just
also
try to
realize.
aim for
Yeah.
50% of what you can
Oh,
possibly get.
I have GTCs in for every single one of my orders. Good till cancel orders. I don't want to use too much jargon, but where I'm automatically out at 50% profit. If it swings my way, and I can get 50% profit, like it'll get me out of the trade. And that's just how I have it set up because I'm in classes. I can't watch my portfolio as much as I'd like to, but you know.
Right, so
Um,
just
And on the following slides, we have probability distributions for two define your strategies. One's an iron condor, and one is a vertical put spread. And we're demonstrating these on SPY, which is the Spider S&P 500 Index ETF. Very liquid product, easy to trade. I wouldn't necessarily want to trade it now because it has low IVR, but it's good to demonstrate on. And a couple.
well, at the time I was recording this podcast.
Yeah, at the time, like, that's you know. But POP, that's your probability of profit, probability of making a penny. That's what that represents.
Mhm. Are you going to be in the green when it's all said and done? And we want to keep this number obviously above 50%
Above
as
50.
much as we can.
As much as we
And over time, the more above 50s we have, the
right,
more
and
likely we are to
with
win.
certain, but
Just-
here's the thing, because we're premium sellers, even if we're at that like 50%, like if we're doing like a neutral trade, like let's say we're selling a straddle, we're gonna have like a 49% probability of profit. But really, that's gonna be a winning trade the majority of the time, simply because of the overstated implied volatility. If we're covering the expected move, we're still it actually tilts in our favor. So
Right, and-
keeping in mind
and
based on the strategy you're entering, like what's going to happen. Yeah, like it's all going to come together in a circle. It'll click for you. It clicked for us. That currently is clicking for us. Put it that way.
Exactly.
P50, your probability of 50% max profit. I'm not entirely sure on the algorithm that they used to come up with this number.
But it's derived from an accurately managed position. Which is
I
a very
believe
key
that's
point.
what it is.
Yeah.
Don't quote me on that, but I believe that it's
From
if
our
you
personal
managed it-
experience so
yes,
far.
Yes. And so it's really not the number I look at most of the time. Most of the time I'm looking at POP, and then if I see a P50, it informs.
If it's
me more on that
ridiculously
trade.
low, there might be
If it-
something you're missing.
Yeah, like
You know
if
what
I have
mean?
if I have a 70 POP and a 1% P50, what's the point of that trade?
Right.
Yeah.
You might be winning, which is what the
But
pop
you're
indicates.
gonna
But
you're
you're
gonna
gonna be
get
winning
eaten up by
half a
transaction
penny.
costs. Yeah.
Yeah, like who
Yeah.
knows? Who knows for whatever reason, but it's just a
Yeah.
good number. It is like a quick glance. Like,
All right.
is
Yeah.
this good?
And we're gonna show you. Actually, you know what? Let's just build it out for him. Let's just build out a vertical put spread real quick. That's
Yeah,
why.
yeah.
Let's just do it. All right, we're gonna go into our broker right now. We use Tastyworks. Love them. But let's make sure the camera is keeping up. What's going on with the camera?
You gotta put it.
Oh, there we go.
Yeah.
Okay. And let's just go to SPY. Let's just go to SPY.
Can you make it full screen too? It's getting a little hard to read there.
See if I can do that. How's that?
Helps a little bit. Yeah.
Okay, so like right here, these are going to be your expirations. You know, we like to trade 45 days. There's no 45-day one open, so I'm going to go on the long side. I'm going to open up the 54s. We have an IV of 15.3%. That's an $8.50 plus or minus expected move. IVR of 30. I really wouldn't make this trade, but we're just demonstrating here, right?
Mhm.
So that's I like to start at 30 delta for credit spreads, and then I like to build around. Like,
Now, what does that 30 delta reflect again?
That 30 delta is going to reflect. If we go to the curve view, if I'm at the 30 delta, I'm going to be right around. It depends. Like I'm going to be right around that 68%. I'm going to be right around one standard deviation. Here, it's not going to be exact. So here I'm at 74% probability of profit. You know.
Mm-hmm.
And that's that would be if I was selling that naked put. But we don't have the capital, we don't have the buying power, so we're gonna define our risk. And so we sold the 228 strike. We're gonna buy it back. Let's make it $2 wide. Collect a little bit more credit.
And the key to this strategy here and where you're making your money is you're selling a more expensive put than you're buying.
Exactly.
And you want to capitalize
And
on that difference.
You're capturing the difference in the
Exactly.
premiums, exactly. And one good rule of
And
thumb.
that difference is going to be our max profit.
Right. And
Yeah.
one good rule of thumb is try to collect 50% the width of the strikes on these kinds of trades. With iron condors, it's more like 1/3.
So in this case, we have a $2 with the strikes, with a
$2
$2.28
wide
and
strikes. We're only
$2.26.
collecting 37 cents. Like there's not enough premium for us to really place a trade. We really wouldn't want to place this. And also, one thing I like to look at is I like to look at what I like my max loss versus my max profit. Like generally, risk 2 to make 1 with these, like these kinds of directional trades. That's a good rule of thumb to have.
And we're looking at a more 4 to 1.
And if you're not collecting enough premium, don't increase your lot size. Widen out your strikes. There's a ton of research that supports this, that goes into it, that I'm not going to bother quoting because I'll talk for an hour and a half. But if you want to collect more credit, if you're not getting enough money, widen out your strikes. Just trust us on that.
Yeah. Let's just keep building this here. I mean, it's pretty much already built here, but
Right,
let's explain a little bit more.
This is a vertical put spread. Now,
Let's go to the
let's go-
curve,
yeah,
so we
let's
can
go to curve
visualize a
here
little bit
again.
better.
here's curve view. So basically what you're doing is, if stock moves anywhere in this green area, or stays anywhere like in this green area, you can see I'm pretty much covering almost the entire expected move of the stock.
Right, and that's
Right
what that
here.
red bar right there represents, at least on our Tasty Works
Right
platform here.
Like this one in the middle, not
And
this
that is-
red right here. We're talking about this.
Oh
thing
yeah,
in the middle
the
right
little
here.
red bar.
Yeah, we're talking about this little.
And that's
orange bar.
indicative of the...
That's IV. That's an expected.
Yeah,
move.
the expected move, the implied volatility. That's a good visualization of it
Yep.
there.
And so, let's turn this into a neutral trade. And we're going to turn this into an iron condor, and how we're going to do that, and I think it's important to be able to
And
build
we're,
out your
and
trades
we're
like
currently
this.
in the bullish.
Yeah, this is
position
a
right now.
bullish trade. Even though I'm using the put side, I'm bullish on the underlying.
Mm-hmm.
Right, that's important to realize, like where your directional risk. But now let's go neutral. So I'd say let's sell the 32 delta right there. Make this $2 wide right there. This will be an iron condor. We'll show you what the curve looks like for that. I'm gonna widen out those strikes just a little bit.
Just for better visualization.
Yeah. What am I buying at? 239. That's 6. Let's make it 244 and 223. So here I'm hoping for this is a below 50% probability profit trade, just based on the standard distribution. But if this was a high IVR trade, I'd be looking to collect one third the width of the strikes. This is a $5 wide, so I'm collecting 225. Not quite enough premium here, but the actually no, yeah, that would there's some decent premium, but again I wouldn't expect to make that much money in this trade just because of the IV rank, but you're really hoping that the stock just pins, it just stays where it is. If the stock stayed at 234, if it stays at 234 until I sell, that's my max profit. If it just stays there. All right.
So, for example, if you're expecting the stock not to move, that's when you take these neutral.
Exactly. Or if you think nothing's gonna happen. A good example of this would be Netflix earnings. I remember your dad talking about he was going to go super bullish on Netflix. We said no, why not go neutral?
Neutral to bullish.
Neutral
You
to
can
bullish.
lean
Yeah,
in
you can
directions.
lean directions.
But Netflix is a perfect example
Yeah.
of that. They were expected to really overstate their earnings. People thought it was going to go through the roof.
And
But in
they
fact,
had
it's,
51
at the end of the
IVR.
day, it's
After
still-
earnings announced, dropped to 6. Immediately. One day it went from 50 IVR to 6. And that would be a nice trade to put on a neutral play. And earnings are great for neutral trades. Yeah.
Yeah. Mhm.
And so I think now what we're gonna end up doing is probably, let me get out of Tasty Works here.
Let's talk about some of the mistakes that we made.
Yeah, some of the mistakes. Where are you? There you go. So there's vertical spread, iron condor. That's a slightly better visualization because you have the wider strikes right there, so you can see the profit. You can see the distribution a little bit better.
Mhm.
But we're getting to the pitfall segment that we promised.
We're gonna really want to focus on these segments throughout the podcast.
Mostly because Seth is going to be making fun of the stupid mistakes I made.
So many mistakes.
So first of all, we're going to talk about liquidity. Liquidity is king. All right, it can have 100 IVR. It can be the best trade in the world. But if there's no liquidity, you can't get into the trade, and you definitely can't get out of the trade for as much of a profit as you want. And so you want penny wide bid ask spreads in both the underlying and the option prices. if you
And that just shows
and-
that people are buying
right,
and selling.
that shows that people
Yeah.
are buying and selling. Now, if like Amazon calls, like there's a 20-cent bid ask spread, but
Yeah, I mean, it
Amazon
scales
calls,
on the cost of the option as
Right,
well, and
yeah.
the underlying.
Yeah, and so you also want to take a look at open interest. I like to see over 1,000 in the open interest column. I like to see at least a couple thousand in the volume column.
Yeah, let's get a little bit of, let's break down the open interest versus volume too.
Open
because that
interest
can be a
means,
little
okay,
confusing.
volume means is people who are like currently in the trade. Open interest are people looking to open trade.
So they're people who have orders
Yeah,
open.
like orders open that haven't been filled.
Right, and then the volume is the orders that have already
Yeah.
been filled.
Yep, exactly.
All right, cool.
And so now we're going to talk about limit orders, and Seth is just going to tear it to pieces here, and you'll see why when we show you
This
my
is a great
portfolio.
one. This is a great one.
So, like Tastyworks, our broker, makes it really great. Like it makes it really hard to use market orders, which is great because you're gonna get screwed if you use a market order in an options market. I remember seeing a screenshot of somebody tried to buy a United Airlines put. They bought like the price of one put in the contract was like it ended up being $293. I don't know if it was like some algo that messed up or something, but like they paid like $293 for a single contract of puts when they were trading at like 90 cents. So that's pretty cool. That's why we use limit orders. And so
but it goes even deeper
It
than
goes-
that.
it goes even deeper.
deeper than that.
so when you're trading spreads, like one of my first iron condor was an FXC.
even just the vertical put spreads. though. Yeah.
Even just in vertical put spreads, always make sure that this little lock button right here, like,
or whatever,
or whatever
you're
equivalent is,
using, yeah.
like lock that. Make sure, because then that's the credit you're gonna like. If that trade can be filled, that's the credit you're gonna get for it. There's gonna be no variation.
Basically, once you make a decision, make
Right.
sure you've locked in that
Right.
decision because it can and will hurt you.
Right,
in the
and,
future.
and I want to talk a little bit about price discovery and entering trades. In that, I like to, when I'm trading, I look at the bid ask. I like to go toward the side that's favoring me. I like to pick that side by a couple pennies, and then then I start entering orders. If I don't get filled, I move it up a penny. If I don't get filled, I move it closer to whatever the market maker wants.
Right.
Until and eventually you might get to a point where you say I'm giving up too many pennies, and maybe this is not a liquid enough underlying for you to trade.
And just to keep it from a day zero perspective here, I mean, if you have traded stocks in the past, you understand bid-ask spread and whatnot. But for those completely new to it, what you have is you need somebody else to enter in your opposing position on the other side.
And 90%, 95% of the time, it's going to be a market maker.
Yeah, but the point is like you can't. If you see the current price of the stock, say on Yahoo Finance or something, that's probably not going to be the price you're going to pay. It's going to be a little bit up or down from that.
Which is why we use limit orders, which is why we click the
Right,
lock.
this is the whole point.
This-
Is people are going to offer you a certain price,
Exactly.
and you can accept it or not, but it's never going to be
You-
not never, but most
Right.
likely it's not going to be. What you see.
Here's the thing I want to stress: no one's forcing you to enter the trade. If the liquidity is such that you can't get filled at a good price, don't trade.
Yeah,
Don't trade.
might be the best idea in
Yeah.
the world, but bid
Sit on
ask
your hands,
is
man.
very important.
We have right here. I saw Mattel had 100 IVR not too long ago. I was like, man, I got to trade this. I got to get in. I go in there. There is zero open interest. Literally zero. Bid-ask spreads were like 10 pennies
and if you
wide.
forced it, you probably end up with no
I
FXC
yep,
position.
I
yeah.
no, I would probably just end up I'd probably end up carrying it to expiration because I wouldn't be able to get out.
True.
So then I'd have to
true.
pay those extra assignment fees, you know.
Yeah, so pay attention to what you're
yeah,
actually buying or selling
you know,
these at.
like be mechanical, but make sure that you're doing everything. Like I have a checklist. Like I look IVR, liquidity, lock. Like
Lock. The lock, yeah, you want a lock.
Anyway, let's take a quick look at our portfolio here. We have some screenshots, but I'm going to show you in the actual. I'm going to show you here in the actual platform what my portfolio is, and we have FXC, my Iron Condor right here. Let me wait for it to populate. There you go. FXC, this is an Iron Condor, right? This is where I made a mistake. I was going to collect dollar white Iron Condor. I was looking to collect 30 cents. You know, the premium was in a good way for me to do that, and I didn't hit the lock button. So I got billed for a credit of $25, and now I'm down $7 on the trade. I should be only down 2 on, because IV's expanded a little bit. You know, this is not French. This is Guggenheim Currency Shares Euro. So it's basically a Euro ETF or a currency trust, whatever. And I don't care. But it's the volatility's coming from the French election. So hopefully Monday.
I mean, that's another good point, though. You
Yeah.
kind of just like mentioned that, but we really don't care about the underlying.
We really don't.
We could be trading like people picking up rocks somewhere.
Yeah.
It doesn't really matter.
Yeah.
Like, just look
Liquidity, high IVR, like that's all we
Yeah.
care about.
Yeah.
And so, yeah, you know, like hopefully I can take this off. Hopefully I'm not screwed to the point where I get scratched out by commissions. Hopefully I can still make a little bit of money on this trade. But that those extra 5 cents would have been nice.
Yep.
Yep.
Definitely.
And so now here we're looking at Target, and
Much better.
this was a much better trade. And I want to show you guys Target's chart for a second. Not 5 year. I want to go to 1 year, not weekly. Don't ignore the lines. I am not a technical analyst. I will never be. I just did that from my own, knowledge of what the stock had done. So we're gonna remove those. But you see right here, like this is November. This is the election. Everything's moved up since the election, right? Target had a $30 sell-off, and I'm just like, what? Like how do people really think Amazon's killing Target that much? And I was like, you know what? No, I don't think so. I'm gonna fade that Target move. That's just the kind of trader I am. You don't have to pick like that. But when I made the trade, it had an IV rank of 100. I sold the
Which I think is the
vertical
most
puts,
important
right?
part.
Yeah.
Is you had it at 100 IVR.
Yeah, it was,
and you had the secondary notion.
and I had my
Yeah.
market assumption.
Yeah.
Absolutely. And so I sold this vertical put spread. It's $2.50 wide. One thing you do want to look for is dollar-wide strikes in your options, but it's not like, this was a great trade. Like at this point, I feel like I would have been stupid not to put this trade on because it had liquidity and everything. So like if it doesn't have dollar-wide strikes, like there's a good chance that it's not very liquid. But there are some that are liquid that don't have dollar-wide strikes. But I sold it for 90 cents. That's roughly 1/3 or about 1/2 the width of the, give or take, it's like 30 cents off. Half 50%.
It's you collected a good amount of credit.
Good amount of premium. So far, I've been in this trade. I think I entered this at 38 days to go. I've been in it 12 days now. I'm gonna get out of this at 21, or when this hits 45. I'm probably looking to close this tomorrow. To be honest, is what I'm hoping for.
Nice. Have something to come back on for
Exactly.
the next podcast. See how it goes.
Exactly. Let's go back to PowerPoint here.
And I know we just kind of jumped into the whole trading aspect of it, but honestly, that's sort of my best recommendation for it is just go in and jump in.
Hit the button, man.
You're not going to learn unless you go
Right,
out and
right.
try. Like we
Yeah,
tried, we
Put an amount of money in there that you're comfortable losing, and then just try it out.
Mhm.
Like, come on, it's supposed to be fun. Like,
Yeah.
and trust me, it turns
We'll
fun.
make the mistakes for you too.
Yeah.
Like, don't worry.
Don't worry about that. We'll make plenty of mistakes for you. All right, so let's get back to the.
No, not yet.
Let's get back to the PowerPoint. There's a portfolio. Questions, if you have questions, comments, email us, goinggreekpodcast@gmail.com.
Please do, even if you just want to say hello, anything, just
We'd love to hear from you. If you have trade ideas, comments, suggestions, something that we missed, something that you want to hear us talk more about, go ahead, send it to us. We'll do it.
anything you want some research on, and you don't have the time. Like we'll research it for you too.
Oh yeah, absolutely.
Then sit down, tell you what you need to know.
Exactly. We'd love doing that.
Mhm.
I'd rather do that than study for finals. I'll tell you that. For sure. All right, and then see here. Next we have if you're interested in going Greek with us, we'd love to have you on the show, on the podcast with us, whether it's via Skype, FaceTime. If you're in the Cincinnati area, you can probably make the drive, come up and visit if you want to. Just however you want to do it.
Even
we're
if
here
you
to
just
help
want
you.
to be here and do your first trade with us, we
Oh
love
yeah,
it. We love
yeah,
it. Anything.
absolutely.
Just let us know,
absolutely.
guys.
Let us know. That was our first episode. How do you feel?
Feel pretty good.
Yeah,
Feel
dude.
pretty good.
I think.
Let's go make some more mistakes.
No, let's go make some money.
Yeah.
Let's go make some money. All right, thanks guys. Have a good one.